Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. I'm going to step through some of these comments. I'll give comments on the comments and give you my financial opinion. I know I've got a lot of people talking stuff in the comment section. I'd like to comment on it, and I'll address it to everyone on the channel. So let's dive in. I'll give you my opinions. Let's zoom in here so you guys can actually somewhat read this thing. There you go. He says, I think oil and oil service stocks could be the category of high risk, high reward that is soon moving, if not already began, to move to the low risk bucket because of increased earnings and pay down of debt. Oil service probably has the most upside potential now that they have yet to show big profits, just my guess. Well, the oil companies themselves still have explosive upside potential because I think that oil can go up quite dramatically. Not just a little bit. I think that we could go to 150 plus $200 or more in this bull market. And it doesn't mean that, and the reason is because you won't have a supply response for a big chunk of time, and then the demand will exceed it, and we'll get a price spike. Doesn't mean that will stay up there forever, but we'll get a spike of some sort. And I don't know how high that spike will be. If you were to take ratios and say, based off of previous bull markets, and this is not me projecting, this is just history repeating itself, guys. I know a lot of people say, oh, Andy says this. This is history. This is history repeating itself. So let's just do what history, if history repeated and gold, let's just say gold's at $2,000 to make it easy, divide it by 6, we could see $333 a barrel if we went to a 1-to-6 ratio like we have in every other bull market during these types of environments. $333 is easily possible. Now, depending on how much inflation we see in the system and how high gold goes, I don't know. We'll have to wait and see where oil prices go. We haven't seen, we have not seen in history deficits this large where we run out of spare capacity and have a huge deficit. This has never happened before. Never. So a 1-to-6 ratio might be too, I'm being too conservative. $333 could be too conservative. And what makes really good investors is seeing things properly. And I'm not saying that $333, people are going to say, oh, people can't afford it. That's the whole point of it. We have to price out so many people at that time that people can't afford it. Like, I think people have this all backwards. When people talk about affordability, they're like, oh, well, this is the least affordable time. That is when you have the largest squeeze, is when things are the least affordable. So right now, we have companies that are trading at like less than 2 times cash flow, their enterprise value, which is ridiculously cheap, guys. Historically, oil companies would trade between 6 and 8 times their enterprise value to cash flow. 6 to 8 times. We're below 2 on some of them. So what I'm saying is the risk there is way off in the quadrant 1 because your value is already there. Now, if you're in a high risk, high reward area, the high risk is before. That was bottom of 2020 when they could potentially go bankrupt, when their cash flows went to like nothing. That was the high risk area. Now they've moved all the way to the low risk area. And now we've got all this upside fat potential on the price of oil itself. That's a low risk, high reward opportunity. I'm hitting that up. I'm staying in the companies that I own because of that. The value is incredibly good, and all the reward is still there. The market balances are there for a potential squeeze in oil. Now, I don't know the future. I don't know if it's going to happen. I don't know how high it's going to go. No one does. But all of the alignment is there for that to happen. The money is in the system. Interest rates go up at this time. That is all normal. Now, just because interest rates go up does not mean that you will have a crash immediately. It doesn't mean it's imminent. It doesn't mean that it's going to happen in the next 6 months or 3 months. It may be 2 or 3 or 4 years out. We don't know that. We don't know what the response will be by the Federal Reserve Bank. We don't know if they're going to bring that thing back, much like 2001, 2002, and then blow it up again. I still think that we're in the expansion phase of real estate, and that interest rates from the stimulus money is basically putting it on pause. And maybe it'll be on pause, and maybe we have a pullback in it. And but it'll come back because we didn't build the homes, guys. The homes don't exist. That's what solves these problems. Interest rates don't solve jack. They delay it. Interest rates do not solve anything. They're just slowing the liquidity into the system. That's all they're doing. If it's a supply side problem, interest rates don't do anything. In fact, they're probably going to make it worse. So yes, we could have a pullback in the short term, but the problem still exists. I'm not trying to market time the short term garbage, guys. It's not my game. Identifying when it's cheap, buying the crap out of the bottom in 2020, and then riding it until the supply is fixed. It's that simple. It is that simple. Now, I'm using technical analysis to find our opportunities of the laggards in some of these areas. The laggards is oil service companies. We can see it in the ratios. It tells us OIH is cheap, GDX is cheap, GDXJ is cheap, and there's individual companies that on the website we've all purchased at the bottom of falling wedges and everything right in the tip. And now we're up 50, 60, 70% in those. My last year, or this year, 2022, I'm up 40% in my portfolio. And I am not trading in and out of any of these companies. I'm buying new companies, I'm adding to it, and the majority of my rewards is probably from that activity. And I have a diversified portfolio. It's not all in energy, it's not all in whatever. But I mean, I'm up 40% versus other people in a down market. Pretty rare. Pretty rare. That's I'm basically outperforming the rest by heaps. So I wanted to make that comment too. It says investing is risky, but to be fair, Andy seems to have a good strategy. The strategy is good. I'm up hundreds. So from the 2020 bottom, I'm up massively. Massively, guys. Hundreds and hundreds of percents on my portfolios. And obviously, it's not as much when I have a bunch of physical precious metals and stuff. And I've got some 30 baggers, some 20 baggers and stuff like that. I've done very well on uranium. Some of them were 10 plus baggers, but they've pulled back. And I still think that we're doing a wave 2 pullback, and then we'll get a wave 3 coming. That's where I think we are at. Other people think that we are further along in the business cycle and that a crash is going to be imminent. And maybe it is. Maybe the crash comes, we pull on back, we get another good buying opportunity, and then it takes off. That very well could be the case. That could be your bear trap. But to try to time that and get it all perfectly right, I'm just going to ride through it, guys. I'm going to ride through it. That's my take. The timing guys hardly ever get it right. So I'm not going to pretend like I'm going to get that right. Yeah, Jeremy Irons on margin call. There are 3 ways to make a living in this business. Be first, be smarter, or cheat. I think I'm hopefully the first 2. Smarter than the market, not in its entirety, but the strategies that I'm putting in place, I think are smart strategies. And they're smarter than the majority of other strategies out there. And then I am usually first. And sometimes being first means you have to ride through some volatility in the beginning. I could be up 20, 30, 40, 50, or down % in my companies when I first go. And that's why I cost average in to the majority of those companies. I know where to overweight, and I know when to overweight. That's what makes me profitable. It says invest in stocks in a great way. Okay, that's probably just whatever. That's probably more whatever. $300 a barrel. No company could be profitable. If oil goes to 150, you will see high unemployment and demand for oil drop. That's not what history has said. 300 a barrel, given the ratio, is where that demand will drop. We didn't see too much of a demand drop when gasoline was at $5 a barrel. And if you look at the crack spreads, that was basically pricing oil at $2.50. And we didn't see too much of a demand drop based off high crack spreads. So I think that your analysis is wrong here. your opinion is not correct. If we have low crack spreads and oil goes to $300 a barrel, that might be $6 or $7 a gallon for gasoline. Something on the lines of that. Remember when people were saying we're already in a recession, and now the same people are saying the coming recession is going to be horrific? That's true. We could have already had the pullback. We don't know. And a lot of this is usually backwards looking. So remember, markets climb a wall of worry. And right now we have a massive wall of worry and a bunch of cash sitting on the sidelines. I'll just say that. That was a great diagram explaining what you've done. I'm already a platinum sub and have no regrets. You've always gone above and beyond on all your platforms. Thank you. Most people don't see talent in you, but I do. Awesome video. Wondering if I can get a nice shipping video update with our boys. Yeah, shipping is good. Great explanation of risk-reward investment matrix. Andy said earlier, just compared Apple with Enron. Apparently thinks platinum will go to 20K due to some ratios he comes up with. I didn't come up with the ratios. That's what is potentially, what could be potential. I don't say it's necessarily going to go there. I'm just saying the potential is there for that to happen. People with closed minds don't make the money. This right here is closed minds. Apple and Enron are two different companies, but it's the fractal I'm comparing. It's not their balance sheets. The fact that you don't understand that is what gets me a little bit concerned, because I said fractal in there. Yeah, it's the potential moves, not the final price. So what you do is you have to look at history to see what the potential could be. Now, I'm not stating that platinum is going to go to 20,000. What I'm saying is there is a possibility based off historical ratios that it could go that high for whatever reason. I don't know the reason. It could be a hyperinflation. It could be some sort of problem on the supply side in South Africa, which produces 70 to 80% of the production of platinum. It could be anything. I don't know. But that's what history has shown us. And what I'm trying to do, a lot of what I try to do here, guys, is I'm trying to open your mind. Everyone is in the herd and they think herd. I'm just saying, this is a possibility here. This is that. That's all I'm saying. I'm not saying for sure outcomes. I'm not saying that this will go to this direction. What I'm saying is, we have a high probability of oil going higher when we're sitting at $70 a barrel down here. Who do you think's buying? This guy. This guy's buying it. I'm buying it. I think we have a very good risk reward in a lot of these companies, in energy service companies, in oil companies, exploration, production. When you're sitting down at 2 times cash flow, enterprise value to cash flow, and you've got all this potential upside, why not take that upside? I'll take it. I'm just playing the statistics and probabilities, and I'm playing them in the right market conditions. That's all you can do as an investor. That's all you can do. You're not going to you're not going to know the future. So all you can do is you play the statistics, you find what's cheap, and then you find what's good for those particular market conditions, which, we're in a cycle. So typically the real estate cycle lasts about 4 to 7 years in the expansion phase. That's the typical thing. We only had 2 years. We were in the middle of an expansion phase of real estate, bar none, no questions asked. Interest rates going to a level based off stimulus money coming into the system may not be sustainable for the real estate market. Then the question is what happens? Because we were at very low inventory levels. This is where it becomes difficult. It's not easy to make money at that point because we basically went straight in the heart of the expansionary phase, and the stimulus money is slowing it down because it yanked interest rates to an unsustainable rate, or to rate, yeah. But then what happens after it? I'm going to ride through it. Screw it. I'm riding through it. That's my viewpoint because the demand is still there and the houses were not built. When you look at all these cycles, the tops of the cycles at the end of the expansionary phase is a hyper supply phase. Hyper supply. Do we have a hyper supply? No, we don't. We don't have a hyper supply. So what do I think? What do I think this is? Now, I'm in the minority thinking this. I am by far in the minority. And you guys are trying to drag me over into the herd. You're trying to drag this guy into the herd. I'm not going into the herd, guys. I'm sorry. I make my money by staying out of the herd. You guys are trying to, some of these guys are trying to drag me back into the herd. They're saying, well, we're going to have a crash and it's due to the business cycle being late. I don't believe in that because I know the cycles better than they know the cycles, in my opinion. Why? Because I studied them. We're in the middle of an expansionary phase. Could this expansionary phase be delayed? Yes. Could we get a slowdown? Yes. Do I think it's going to be a blowout crash? No. The blowout crash comes from a deleveraging and a destruction of credit in the system. Could that happen? Yes. But it takes time. It takes time. And right now, this is the most juiciest portion for uranium and oil and all these other ones to go higher. So those interest rates could come up, but it may take a year or two for that to impact the markets. It may take a year or two or three for that to impact the real estate market, to impact the businesses that could potentially go bankrupt. It's going to take some time to filter its way through. Everyone thinks it's immediate. I don't think it's going to be immediate. Now, I could be wrong. And you guys can obviously have a differing viewpoint on that perspective there. But I also see in the technical charts that a lot of these look ready to blow to the upside. So I'm staying long. And maybe we have another year of good upside moves. And in the last year, you could go up 2, 3, 4, 500%, depending on the companies. And maybe we have to ride through a slowdown. And that happens on the opposite side. I don't know what the short term will necessarily hold. I don't think anyone knows. But I can tell you everyone's bearish. Usually when everyone's bearish, that's usually when it doesn't happen. It may be another year or 2 or 3 or whatever it takes for that to filter through. And then, I know a lot of people, they're going to take people who are highly qualified, who have good street credibility for making potential calls or whatever. And then they're going to try to pin it against my opinion, which is fine. But it doesn't mean they're right either. We are now debating kind of when something will happen. I think that's the least accurate. I think we all agree on where we are in the cycle. We all in agreement. And a lot of these guys don't know the real estate cycle. I don't think they know what drives it. I don't think they've done the homework on that side. So what they do is they take their leading indicators. They take indicators and then they compare it to history. And then they say this is going to crash because of that indicator. Now, my question is, what drives the indicator? What drives that indicator for them to make that claim? They don't know. They just say the indicator's doing it. They don't say, hey, look, this is coming from the real estate market, and it's particularly coming from the housing starts. They don't know that. And some of these guys, they just say the indicator's rolling over, therefore it's going to do this. Maybe they're right. Maybe they're wrong. But that would also indicate if they don't know where it's coming from, they wouldn't know the size of this thing. Because if it's coming from the real estate market in every single time frame before that, and we had a hyper supply phase and the housing starts dove because of that, your deleveraging came from the real estate market. If we're in the middle of an expansion phase and we don't have the hyper supply phase and we don't have the deleveraging, the crash won't come. It will be a small pullback from a stimulus overhang, so to speak. It's like having a hangover from drinking. That's the stimulus hangover. But it won't be a blowout crash like it would be in the 1920s or the 2008 type scenario. Unless they hold interest rates at an obscene level for a very long time. And somehow we see an impact from like businesses or something. But I still don't think it would be a blowout crash. I think it could be a pullback. And I agree. I think we're going to see a pullback in the overall stock market. I've been saying that the entire time, though. And I do think that we're going to have a recession, but it's going to be inflationary, not deflationary. And there's big differences between that. I know there's supply problems out there in commodities and energy. We can already see that. And yes, the inflation will slow down because we had the stimulus pump. So on a year-over-year basis, if you take this calculation over this will close that gap over time. It will be a disinflationary period for a period of time. It's not disinflationary because of a demographic slowdown. It's disinflationary because of the stimulus money in the system. And when that comes down, we could see a resurgence in inflation again. Why? Because they held the very thing down that causes the CPI to go up, which is oil. So yes, it's really complicated because we haven't seen this type of dynamic in the markets before. We haven't seen a stimulus pump to this extent given to people in their hand, in the hands of people. The way that this money works into the system through the CPI is the money has to get into the hands of the regular person to give you that increase of commodity demand. They did that in the beginning of this. Now the question is, what is Act 2 in their play? Act 1 is to raise interest rates, slow this all down, kill demand if they can, and try to hold it. What's their Act 2? Are they going to hold it there, even though we could have a bad recession in stocks and some of these other things? Or are they going to back off, pump the money system again, and then all of a sudden you've got the shortages in commodities again because they haven't been fixed from the supply side? They are constrained. The Federal Reserve is constrained in what they can do. They can't pump the money system even though the debt in the system needs to be pumped. They're screwed. They're stuck. That's where the opportunity is, because if they're stuck, they're going to have to make a decision. They're going to say, we're going to pump this thing because we're going to hold and back our bonds. And they've got a lot of issuance of debt coming up next year. We'll see. They need to engineer. Basically, what they need to do is they need to engineer a recession where people buy bonds. Because if they're going to release all these bonds to the market, they need potential buyers. If they don't have buyers, if inflation pushes this thing higher, if oil pushes inflation higher, they're screwed because nobody's going to want to buy bonds. And then they're going to have to release record amounts of bonds into the market. They're going to have the demand for it. Interest rates are going to go up in that type of environment. That means that people who think that a deflationary type movement's coming and positioning in bonds will be wrong if that scenario plays out. So I'm just bringing up ideas, guys. I'm not saying that this is 100% outcomes. I'm just giving ideas, and you guys can do whatever you want with it. On the website, I go over all this in detail. I have a bunch of information on the website describing all this stuff and the cycles. And then you can ask me directly through the question and answer sessions for the Platinum members. You can ask me directly, how does this work? Why does it work? What are we looking at? Why are all these charts showing us that inflation is going to come? It's not me making that opinion. It's the charts basically positioning for it. I am deriving my opinions based off of the evidence in the system, based off how these assets are moving against each other. I'm not just picking an opinion out of the air like some people do. So that's what I'm going to end on there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Use the word discount in the coupon code if you want a discount. The Platinum membership's the membership I would choose. It gets you access to everything. You can ask me questions. And I wish I had someone like me when I was 20 years old showing me how to do this. 100% agree there. Now, would I have paid for the membership when I was 20-something years old? No, because I was cheap. If I could go back and tell myself to learn from myself to become a Platinum member, I would. I would, because it would drastically accelerate what I know about the markets very quickly. And that, I think, is the most valuable thing. It's being able to identify where you are in the cycle, business cycle, and which is basically the real estate cycle. The business cycle and real estate cycle is the same thing. And then it would tell you kind of my viewpoint on how to buy stuff that's down. I didn't do that when I was really, really young. I was chasing stuff. And if I could learn that in my early 20s, then that would make me a deadly investor that much earlier. And then I could replicate it over and over and see these cycles. But that's what I've got for today, guys. Hopefully you guys are doing all right. And we'll catch you next time. This is Finding Value.